I think the market's quite healthy to go public right now, but I don't think it's people aren't going public because the bankers aren't interested or because they're not investors out there that want to invest. I think it's companies, frankly, get very, very comfortable living the private world. And in many cases, they've taken some cash off the table, which I think is a
Okay, so
mistake. I think it's a mistake. I think it's misaligned a lot of the, a small amount, a very small amount I can understand, but I think some of these have been very large amounts. And so it's misaligned the objectives.
yeah, when I see the founder taking 25, $30 million off the table straight into her pocket, I'm thinking our fund needs to be selling on the secondary market as well.
If you
Um,
can. I have been fortunate. I think I counted the other day. I've been on collectively over 40 boards in my career,
mm,
public and private. So a whole host, and I've seen just about everything. And I tend to get associated with companies that I really like, and I believe that we have fair governance, but governance that also not only is a good corporate governance, but also constructive from the point of view of business, from the business angle. Yeah, what I learned there, very, I would say carefully here, is the value of a board in having a board that's value add, but also works well together. And we historically had too many different activists involved, all the way back to Carl Icahn and stuff. So some of the activists were very good in value add, like Dan Loeb was spectacular at Third Point. Others I would not speak as nearly as positive of, and without getting into names. And they probably feel the same of me. That's okay. I think having a board that is aligned with your interests is really, really important. Doesn't mean you have to agree, but having one that works well together. And I would say, clearly not all activists are the same. And Yahoo, we were not helped by having a lot of disagreements within the board as to how we should proceed as a company.
Hello and welcome to Fireside with VC. My name is Andrew Romans, and today we're with Ken Goldman, a real Silicon Valley story if there ever was one. Ken was the chief financial officer, the CFO of Sybase, back in the day when there was Sybase, Informix, and Oracle as the only relational databases after hierarchical databases. Big stuff in the old world of open systems in the Unix world. He was then the CFO of Excite at Home when the internet was exploding, and it was probably a .com IPO, I think, but he'll tell us. Then became CFO of Siebel Systems, so working with the great Tom Siebel, who I guess gave birth to Mark Benioff and what is now Salesforce, and probably saw that through to the Oracle acquisition, so dealing directly with Larry Ellison of Silicon Valley lore, and was then the CFO of Yahoo. And probably there's an Alibaba story to be told in there as well. So fascinating set of experience. So Ken, thanks for making time to talk to us today.
Yeah, it's a lovely Monday here. Just got back. I was in Tennessee, actually, at the Blackberry Farms of all places. Did a very, very long hike, which I hadn't expected. So yeah, it's good to be back home for a few days.
Okay, it was probably a bit warm there. It's probably was it getting a little hot?
Yeah, it was toasty. Got up to about 90, but it was dry, didn't rain, so the weather was actually quite good.
Okay, that's great. Well, listen, why don't you take us back to the early days of being CFO of Sybase? I mean, how big was the company at the time that you were joining? It was probably already a big company. Was it like 92 or around there?
I joined Sybase in 1992, and I left in 96. We were about 200 million when I joined. It was about $1 billion when I left. We rode up, it's been a while ago, but we rode up the database industry, and we were giving Oracle for a while a run for their money, so to speak. I enjoyed it. We had, I'd say between Sybase and Siebel, we had the two best sales organizations I have ever been associated with. And so we killed it. I learned a lot of great practices on how to run a sales. I wasn't running sales. but I was very involved in sales, so I learned a lot in those periods of time. So one was database software, the other one was application software.
Yeah, I mean, I remember Sybase had this reputation for being faster, and so
Mhm.
Wall Street liked it, and so you'd see Wall Street would seem to elect for Sybase over Oracle. But it's interesting what you mentioned, learning a lot about sales. I think of Tom Siebel as someone who like wrote the book on the enterprise software sale cycle, and like does the CFO of the company you're selling to have they heard about this project, or like you're on quadrant 3 of slide 4 of the playbook on how sales was done. Was Tom Siebel as influential as people say and kind of proliferating through the organization?
Yeah, he and I still sometimes see him a lot when I sort of do some advisory work for C3, but yeah, he's all in. He's as intense as anyone I've ever seen. That comes from actually comes from a technology background, but he's very, very involved in sales and doing deals, for lack of a better way of saying it. He's very regimented in his approach. He knows the details and facts like there's no one else. I can still remember him at Siebel. He'd be talking to the sales individual, and he would know as much about many of the deals as the head of sales, which is one of the reasons why they didn't always last too long. So no, he's a master of selling and understanding human behavior and understanding what you need to do to win a deal. So no, he's very good. But we had a very good sales organization at Sybase as well. It wasn't Tom, obviously, but CEO there was Mark Hoffman, and we had a great sales organization, great folks that ran their various regions, and I learned a lot, and we were on a roll. We were on a roll while I was there.
And the Excited Home, did you guys IPO? Was that under your watch when the IPO
Yeah, we
happened?
just to sort of put a little exclamation point. I've been fortunate. This is you get. You make your breaks. You also get lucky both. I was involved with John Doerr from Kleiner Perkins. He was involved in my first startup back in the '80s, VLSI Technology. He helped recruit me into Sybase and Cypress. So I actually started in semiconductors. So I was at VLSI Technology, Cypress, and so he was involved in both of those as well as Sybase. He brought me into a startup which was Excite at Home. Actually, it was at Home Networks when I first started it and became Excite at Home. And I joined there in 1996. We did go public in '97, so that's true. So yeah, we were a public company for a while, and we basically ushered in the high speed internet. We did it with cable and we do it with cable and using cable modems sometimes. I mean, even me just talking about now seems so I'm dating myself because it's but at that time we were talking about there was a technology called DSL, which you would do over the telephone network, and cable modem. Cable was how you do it over cable, and we did it over cable. And there was a question of what would be faster. And, frankly, they both turned out to get faster over time. And I would say they're relatively equivalent. Depends upon where you live. Interesting enough, we didn't think satellite would be a strong competitor because we thought it would be much faster going down and up. But technologies like Starlink have really shown the benefit now of satellite as well. So yeah, so no, it was a great run. There's a lot of lessons I've learned. We can cover wherever you want to go there. But we had a great CEO while I was there for the first 3.5 years, and then when we merged with Excite, which is why it became Excite at Home, it went in the wrong direction there, partly because of the new CEO that came on board and some other things that we did that I didn't agree with, and one of the reasons which led me to leave the company. And that's one of the things we can talk about is what precipitates me leaving companies, and is usually a short list that precedes me wanting to make a move. Sometimes
So,
it's easy because you get M&A.
so what would be causes for you to leave one of these companies?
There's the simple ones when you sell. So in the case of Yahoo, we sold the company. So that is in the case of Siebel, we sold the company. So then it's very simple. You stay on to hopefully an orderly transition. There are other times, and Excite Home was when I had no confidence, honestly, in the CEO. And I've learned in life that if you can't adjust things the way you think makes sense, it's better just to move on and not be part of something. And that was the right move. Ultimately, the company went under, which I believe, because I could see they were spending more money than I thought made sense. And we went from a cash positive to a negative point of view, a negative results. And I did not agree with it. So I left. I left then, and then other times, a better opportunity comes. When I was at Sybase, the opportunity came to work at home. So that's when John Doerr recruited me, and that was just a case of going something else that was better. In the case of Fortinet, which was a great run, took that company public. When I say took, as a bunch of us took the company public, so it wasn't me. But nonetheless, when I left Fortinet, because Marissa Meyer came calling, and I always loved internet. I got a taste of it at home. So that was so there's a case of we had a great run, but I wanted to go work at a $5 billion company as CFO, and so that's why I left there. So it varies. I would say the simple one is when companies get sold. There are times when I lose confidence in management, and instead of making waves, I don't like to make waves. I don't think it makes sense to make waves, and I know some people do. I prefer to just move on. I think it's good. I tried. It's better to make friends and not make enemies as best you can. And so when I don't agree with management, I don't think I can adjust or change management in a way I believe makes sense strategically and tactically. It's best to move on, and I do it in a very professional way. Frankly, when I left Fortinet, now I agreed with the company, and actually now I joined the board. Since I rejoined the company, but joined the board about 3 years ago. In the case of Fortinet, I gave over a 4-week notice, managed the earnings in the filing of SEC filings, and then the next day in the weekend I was over working at Yahoo for their earnings the following week. So it's very important that you leave you leave and you start companies in a very professional way. Matter of fact,
And
I once had a boss tell me, my first CFO job, I once had a boss tell me it's more important to how you leave than how you start, because that you leave the that's how you leave that's how you leave the taste of the company and the prior CEO, and you never know when you need a reference and referral and so forth. So I would just say for those listening, I think it's extremely important to leave a company very professionally, regardless of the situation, and it'll always do you well. And I've mentored other folks accordingly.
yeah. And some of these companies were quite large at the time that you joined, and yet it was John Doerr bringing you in. So venture capitalists were still active. How active were VCs at these companies leading into going public? And then after you go public, do the VCs sort of disappear and start selling off, or were they continued to be board
Well, that's
members
a good
and playing a
story. I
role?
mean, I'm going to give you a couple of anecdotes. One, when I was on the board, I still am on the board of Zora. Um, we took the company public collectively. I was on the board, not the CFO. And I was, some of the venture folks decided to leave, some stayed. I actually like venture folks staying on. I guess for the venture folks on this call, maybe you like what I say, maybe you won't. I think it's very helpful. I think the institutional knowledge they have of how the company started, is really good. I think it's really helpful. You don't gain that when the new members come on board. So I think as long as the venture capitalists can stay and they can create capacity with their other obligations to stay on the board, I think it's very helpful. not everyone agrees with me. Some people say, geez, it's time for the new folks to come on board and let the VCs go off. But I've always enjoyed, yeah, they get a lot of credit for companies that go public and success and having their capability. And, in the case of Zora, for example, we have a couple of folks that have a couple stayed left, a couple stayed on, and the two that stayed on have been tremendous value add to the company, and are very, very committed. And so I like that as well. But I recognize sometimes VCs do have to leave, and so they do move on because they have other commitments. But anyway, that's my point of view. So I think I would prefer if the venture capitalist has the time capacity and the interest, I would more often not prefer them to stay on.
Sam, and what's the right number of board members at these different companies? Because you've been at quite a few different ones.
Well, the old guru of mentoring, coaching in the Valley, Bill Campbell, used to say 7, 3 for audit, 3 for comp, and the CEO that's not independent. But I think actually that gets, you now have a nom-gov meeting, and, Bill was a different era when nomination governance wasn't quite as important as it is now. And I also think, they have different points of view. Diversity is very helpful and important. So and diversity comes across in a lot of different ways. I can cover that later if we want to. So I would say companies I'm involved in, I sort of like 9. Not that it has to be an odd number, because I would tell you, and I'm not even sure I can make one hand the number of times that, a vote has not been unanimous when we're voting on matters. But 9 seems to me a nice number. You can have you have enough to handle 3 committees, and you have a little bit of overlap on one of them or 2 of them, and you have it's traditional to have the CEO on the board as well. So I've found 9 is very workable. When it gets up to 10 or 11 and 12, and I've seen larger when I was at NXP Semiconductor, I think we're up to 11, but that was a much larger company. We also had a larger number at Yahoo, which was also a larger company. But I think 9 becomes, a comfortable number, at least in my opinion.
Okay. And what is your perspective on going public or staying private? A lot of companies today, ever since the dot-com crash, really, and Sarbanes-Oxley, we entered into a sort of stay private longer, stay private forever world with a vibrant secondary market where there is liquidity, sometimes even for employees, investors, founders. What's your sense on the advantages of going public, and where do you think society should be heading?
Well, I'm going to start with a little bit of a controversial comment. I was talking to one of my VC friends on one of his, fund I'm in, and they're doing, an extension. I asked them, why are you doing 1 year? Because I know it'll take more than 1 year for some of your remaining. And he said, well, my LPs prefer it that way. That seems to be a standard. And then I said, well, geez, then I said, your firm's been around. This particular fund has been around for 13 years. And he said, yeah, but our vintage, we're seeing funds last 15 to 18 years. I bring this up, and I've been vocal on this. I think the venture model is becoming broken until it changes a bit. You mentioned secondary. Again, another venture firm I'm involved in, I don't want to say the name. They mentioned one of the things they learned that was a mistake they allowed during the 2021, 22. When things would go up and to the right too much, they allowed the CEO to sell a lot of stock.
Yeah.
And they took the eye off the needle, whatever the term is. And so I think the reason companies are staying private is many. One is you allowing management to have secondaries, and so they get flush with cash, and they don't have the same urgency that I have always had when I was CFO. That the only way we felt there was an exit was either an IPO or an M&A, and I always preferred an IPO, and I'll explain that later. But I think now the alignment is not always clear, and the management teams, a lot of times they do secondaries and they're able to stay private longer. But unless there's a very formal, unless the company's big enough and formal enough that you can have a secondary of LP interests, that it's very hard, because you as an LP, you're in and stuck, so to speak, and the management team is very comfortable. And I'm looking at companies, that are staying, private now, 10, 12, 13, 14 years. I mean, look at Stripe, as an example. Data Robot, I think, is one, and not Data Dog. There's another one that I can't think of, another data. It's been these are very successful, have 30, $40 billion market cap, 60 billion, but they're still private. I've felt that I used to say real men go public. I now say real executives go public. I have found my own situation, both on the boards I've been in as CFO. By and large, not exclusively, but by and large, companies do better when they go public. The management teams, I just look at Fortinet. We did much better as a company when we went public. The management team there likes the competing in the real world, as I say, and really wanted to, and we also felt it was very helpful to selling our product that we were selling to large enterprises. And we felt it would be very helpful to be in the public, so that our customers, current and prospective customers, could see our financial results. So we always thought that was very important. My first, IPO is back in the 80s. I'm aging myself now. We went public 3 years after the company got started. It's unbelievable, 20 million in revenue. At Home Network.
So you went public with 20 million in revenue, but that was back in the 80s when 20 million was maybe a lot more money. But that's an interesting metric. So in 3 years. So if you were an investor in that and the company IPOs after 3 years, that's kind of unheard of these days.
Now it's I would say what I'm seeing, I think it used to be funds used to have a 10-year life. Now the life of funds is more like 20 years. In companies, I would say it's unusual for a company to go public in less than 10 years. Unusual. I think it's, I think it's going to hurt the venture industry. I'm seeing a lot less funds getting started now. There is, I think 300 or 400 billion of, dry powder. And there is, I have a chart, which I don't have in front of me now, of the amount of money. There's actually trillions of invested capital in both private equity and venture now, and it keeps on going up. It's going up dramatically. I think it's going to make a problem for LPs to continue to invest, and for therefore general funds to raise new funds until we work through this. So I don't know. We've gone to a situation where, in the old days, by the way, there were no secondaries. You could not, I don't think through 2005, 2010 when I think of companies as an executive, we were excluded. There was no ability to sell unless there was an exit transaction. Now there's a lot of sales to secondaries for management, but it's hard for LPs. What I see now, and by the way, those secondaries, way they've been done is when, which I disagree with, when funds invest in companies, they invest some primary capital and they invest in capital secondary for LPs, but they don't, for management, but they don't allow their funds to go into existing venture groups. So that's one of the ways that the management sells. But now if you try to do a secondary on many of these funds, and I just heard this, a couple of days ago now the rage is secondary funds, the rage is continuation funds, but the discounts on venture funds can be 30, 40, 50% of the NAVs. So it's very extreme. So the continuation funds and secondaries are more so on private equity, where you can get more like 80, 90% of NAV or even higher. But the VC market is a lot of people just don't believe the marks on VCs.
Right. So the secondary market for LP stakes is got like, I think of Hans Swindon from Industry Ventures saying he's looking for a 45% discount to the NAV when
Well, okay,
buying.
well, that's exactly the number I was saying. I said
Yeah,
40, 50. So I didn't know that's what he's saying. And so, yeah, I think the bid ask is pretty wide
yeah,
on venture, which is why you don't see as much. I think there was a fund that just raised money. I think Stepstone is going to be doing. They just raised a fund. They're going to go after secondaries and VCs, but there's a wide disparity between bid ask on NAVs on venture, much tighter on private equity. Because in private equity, you talk about real companies, real value, real fundamentals, so it's easier to value. On venture, it's much harder to value in many cases unless the companies are far along.
yeah.
And
I
I
think
think
that,
some of the venture valuations, have not adjusted for the 2022, 2023 effect. And so some of these are still based are small discounts to what they raised in 2021 or early 22. And so there's a lot of disbelief in some of the marks.
yeah, if a lot of companies raised at very high valuations in 2021 and secondary market of those individual startups, was hitting like 86% below the last share price. And so, years going by and they're not even flat. They're still down on what people are willing to pay to buy. And sometimes that becomes a buying opportunity. If you can buy shares in that startup at 86% lower share price than what it was raising on back in 2021 and the company's gotten healthy, that's not a bad thing. But if you're looking for liquidity and you're entering year 14, 15 of a VC fund, the LP secondary market's going to be brutal, and trying to get liquidity on the portfolio level, is a case by case, story for sure.
Yeah, there's a new saying that DPI is a new IRR. Distributed proceeds on investment versus internal rate of return. I have heard, again, this is from a conference. I was listening to a conference last week. I'm not privy to say who it was, but they said, the 2 and 3 year continuation, private secondary funds in venture, the DPI is almost zero. So even though there's a pretty becoming more active in the secondaries for VCs, there's still not a lot of DP. And you just look, all you have to do is look at the screen and see the lack of IPOs still, and you see the lack of exits. And I think the market's quite healthy to go public right now. But I don't think it's people aren't going public because the bankers aren't interested or because they're not investors out there that want to invest. I think it's companies, frankly, get very, very comfortable living the private world. And in many cases, they've taken some cash off the table, which I think is a
Okay, so
mistake. I think it's a mistake. I think it's misaligned a lot of the, a small amount, a very small amount I can understand, but I think some of these have been very large amounts. And so it's misaligned the objectives.
yeah, when I see the founder taking 25, $30 million off the table straight into her pocket, I'm thinking our fund needs to be selling on the secondary market as well.
If you
Um,
can, if you
yeah,
can. But the problem is a lot of these, because I had this discussion with someone, the problem is when a new investor comes in, they're giving primary capital to the company, and they're also providing some secondary to the executives, but they're not going to allow their money coming in to go secondary to existing VCs. So that's where some of the misalignment comes from.
well, what we've found in some cases is that these new funds coming in are promising their LPs they're going to have a 25% ownership stake in these businesses at the time of exit. And they're coming in rather late compared to us. They're coming in like Series C, D, E, and the company's really only issuing 10% stock in that entire transactions. A lot of existing funds have SPVs and are taking it up. So the lead investor might only be getting 5% ownership if a late seed Series A fund like ours raises their hand and say, how'd you like to buy another 1% of the business buying our Series A preferred? They're probably looking to increase their ownership target. So that's where I find it works. If our fund was a $3.2 billion latest NEA fund, then this doesn't work.
Yeah, I agree with that. If they believe you're sort of a very very small fund, or and not a major fund, and you're a seed oriented fund, then they might allow you to do sell some of the secondary. But if you're a major fund, Cape kind of Perkins, Andreessen, Benchmark, whatever, they're not going to allow you to do that.
Yeah, yeah, yeah. So they should be, like you're saying, less tolerant of the CEO doing a massive secondary and
At least
removing all the
that's
urgency.
my strong point of view. Yes.
Yeah, yeah, yeah. I think it's very case by case, but we've seen it with like big light speeds come in and they offer even more secondary than primary. And then the CEO is in no rush to ever IPO or sell. And they can even get comfortable overspending and being unfit, as a growth company that doesn't even need all that money, for
That's
spending.
true. Also, it depends upon who has the control. Either directly or indirectly, and then you get into the question of sometimes some of the CEOs actually have dual class stock. It's not too prevalent in private companies, but sometimes they do, and so they have control, and so therefore it's harder to adjust what they want to go do. So yeah, I have been fortunate. I think I counted the other day. I've been on collectively over 40 boards in my career,
Hmm.
public and private. So a whole host, and I've seen just about everything. And I tend to get associated with companies that I really like, and I believe that we have fair governance, but governance that also not only is a good corporate governance, but also constructive from the point of view of business, from the business angle.
And talk a little bit more about advantages of going public. So you mentioned that when you took this company public in the 80s with 20 million revenue or 40 million revenue, you were happy for your sales team to disclose your financials to your prospective customers or existing customers. You almost think these days people prefer to not do that. But what did you see as advantages of being public? A currency to buy other companies or
Yeah,
general
no,
pride?
yeah, you bring a good point. It is a currency to buy other companies, or to do transactions. How it's very public, but Fortinet's done a number of transactions over the years, sometimes for cash, sometimes from small amount of stock, and so yeah, so having currency to buy other companies, or both having enough cash in the balance sheet that you could buy them for cash, you can buy them for stock. I think is very helpful. And then and by the way, then they know exactly what the price is. So if you have a private company, then the question is, for you stock, what is the value correct or not correct?
And
And
that's
so
been an issue for us. Like we had a company acquire one of our companies with all stock, and the valuation was somehow inflated beyond the last funding valuation. And then later that company got acquired by Amazon and we did quite well in the end. But
no, good for you. Yeah, good
I
for
remember
you.
being like, who the hell agreed to this valuation that we're selling to for
Right.
stock to a privately held company? Um,
Well, good for you. No, that's what I say. When you have a public stock, then it is the price is it is what it is. It's a free market, as opposed to being in a private company. It's either the last round, or some valuation people, or you have a 409A. You have a variety of different ways, and none of them are perfect. At least in the public world, it may not be perfect, but at least it's a public mark. So I think that's helpful. Obviously, going public, it provides stock, cash. I mean, it does create, as I say, liquid stock. It's sometimes it can be either easier or harder depending upon your perspective of recruiting folks. I think in enterprise sales companies, it's not exclusive, but certainly the ones I've been associated with, we will help go into customers so they knew our financials. Now, if you're big enough, then frankly, it may be if your financials are either well known enough or you can provide them. And sometimes private, you would provide them under NDA. But I have found it's easier to sell to large enterprise customers when you're public. As I say, it's the real world. I mean, if you want to, if you want to be in the big leagues, you want to be, in basketball, you want to be playing the G League, you want to be playing the NBA. So I'd rather be playing in the big leagues, and that's how I think. It's how I've grown up. I've always believed, and I had this discussion many times that when I started companies, you assume you're going to be successful. And so I've always gotten the A, even at smallest size, A players. So I get involved the A bankers, commercial and private, and investment banks. I'd have a big four, actually in the old days, big six, big eight accounting firms. I would have great legal firms locally here in the Bay Area. And so I would always work with the best of the best. And that's how I've always thought. And so to me, going public is just a natural transition to working in what I call the big leagues. And it's the real world. And I like competing in the real world. That's who I am and how I believe. And I just think staying private, it's too easy to feel like you're a little bit in a cocoon.
Yeah,
That's my opinion. Not everyone agrees with me, but that's my point of view.
well, I think that LPs need to, it needs to be a two-way street. It's like a broken modem that just receives data, doesn't send data. You've got to send the money back to the LP if they're going to keep sending you money. And the stay private world puts us in the tricky secondary
I
market,
think it's
which is
gonna
not
at some
always the
point.
fair price.
Yeah, I think at some point, if it doesn't change, you're gonna see a lot less money going into venture capital versus other, areas, be it private credit, which is the rage right now, or private equity, in which these folks are very attuned to a 3 to 7 year hold period, or maybe 4 to 7 more likely. I think there's going to be a lot less money going into venture if we don't solve this, because it's in my opinion, it's a broken model right now. I just think when 10 years, even 10 years is long enough. Now you're talking about funds that last 15 to 20 years. That's too long, in my opinion. And by the way, you start looking at IRRs, and so whatever could have been a good IRR at 8 to 10 years, it becomes a very tough IRR when you're talking 15 to 20 years. So yeah, maybe you make 2 times your money, but if it takes 15 to 20 years, you're now making single-digit IRR.
Yeah, yeah.
You might as well just go with in the public markets, and you have pure 100% liquidity, as opposed to private, we have no liquidity.
Right. There should be a premium for the illiquidity of venture, and you shouldn't be losing to inflation either. And the funds being so big that the GP is getting paid 20% of, whatever the profit is, and over that period of time, it's not really justified. Let's switch over to M&A. So I guess, you sold Siebel to Oracle, right? So dealing with Tom Siebel, Larry Ellison, all of that, was that like all? I have no idea. Was it cash, stock, both? What were some of the
It
dynamics?
was.
That's a
It's been
big
a
one.
while. It was actually a mix. I think it turned out to be something like, if I remember correctly, some 70% cash, 30% stock. Many of us in the company, I still have actually Oracle stock. We prefer to take the stock versus cash. We believe in Oracle, and it's been Oracle stock's like 140 today, so it's been a great run if you took stock versus cash on that situation. So yeah, it was a very good move. I think it brings up a point of CEO succession in private companies is very hard. I'm on the board of 4 public companies right now, all of them with CEO founders running them. I happen to work well with founders. I like founders, but I've also found it is not easy to transition to a new CEO. In the case of Tom, he's very direct, he's very intense, very opinionated, very good. We had a hard time finding a very hard time finding a successor to him. It didn't work out well. found one, and then we had another one come in, someone that was on our board, very, very good, but Tom just felt that he had too much involved in the company from an investment point of view, and preferred to see an exit, if you will. But I have found it's very hard to succession planning on founder-driven companies where the founder is very happy staying there and thinking about, and then they think about how to change, is very hard to find someone that has their ability to understand the the landscape. And it's in the case of Siebel, and I've seen this in other situations too. They want to change things too quickly, and too contrary to how the CEO was running it. And if the CEO who's now chairman still involved, you find out that match is not going to last long. Just not going to last long. In the case of Siebel, this is all public. It was clearly we moved on from the CEO, who was actually quite good, but he was doing things that Tom didn't agree with.
Sometimes the body rejects the organ when you try to
very
do
much
a
so.
heart transplant.
There are sometimes very successful ServiceNow. I'm just saying it has had great runs of changing along the way. So they've done it very, very successfully. So it is done sometimes successfully, but it's not easy either. Not easy.
And what are some of the timeless lessons of agreeing to an earnout and an M&A situation? You have no control over making that earnout happen, or is it get the cash up front? What are your...
Well, you can do earnouts in private companies. I don't know. I don't think it works on. You can. I do see sometimes earnouts in medical and biotech companies in public. I don't see them quite as prevalent in technology companies. My experience is there's a lot of contested issues on earnouts and how to first of all structure them and so forth. So yeah, we did, in one of my companies, we bought a private company, we gave an earnout, and the earnout is relatively small, so it's it's not, you're not going to get a lot of contention in it, but if you have a bigger earnout and it's public, it can be it can be contentious. So then you don't see them that often, actually.
Okay. And how about Silicon Valley versus the rest of the world and some of your international experience? I know you were CFO of Yahoo, and I remember hearing that Yahoo's investment in Alibaba, they understood the internet. They also had Yahoo Japan, so they had a real appreciation of this could be important investment to make. But what's your experience about that? Or were you there for those days?
I would. That was to Marissa Meyer's credit, when when she went to Yahoo and I came right after her. She recognized the value in Alibaba, and we adjusted. We had a certain requirement amount of shares to sell back to Alibaba, and a certain amount of shares to sell in Alibaba's IPO, and she adjusted those numbers down because she believed in the long-term value of Alibaba, so that she created billions and billions and billions of value add to Yahoo shareholders by her ability to adjust the original agreement we had with Alibaba, that was done by a prior management team, and prior board. So credit to her. Now, and we were able to ultimately exit that at very, very attractive rates. And particularly in retrospect now, because Alibaba was at one time was basically $1 trillion valued company. I think almost. Someone told me that day it's now 180 billion, given what's going on in China. So in Yahoo Japan, I don't remember the numbers quite as well, but it also became very valuable. We owned, I think, 40% roughly. I may be off a little bit here. The valuation of Yahoo Japan was almost the same valuation. I think 5 billion as Yahoo was at the time, Yahoo Core Enterprise. And so Yahoo Japan was a very valuable. It's one of the things that made it easy when Apollo came in, and Verizon and Apollo, because they realized the value of Yahoo Japan and were able to monetize that. So yeah, Yahoo, what I learned there, very, I would say carefully here, is the value of a board in having a board that's value add, but also works well together. And we historically had too many different activists involved all the way back to Carl Icahn and stuff. So some of the activists were very good in value add. Like Dan Loeb was spectacular at Third Point. Others I would not speak as nearly as positive of, and without getting into names. And so, and they probably feel the same of me. That's okay. But so I think having a board that is aligned with your interests is really, really important. Doesn't mean you have to agree, but having one that works well together. And I would say, clearly not all activists are the same. And Yahoo, we were not helped by having a lot of disagreements within the board as to how we should proceed as a company.
And what's your advice to enterprise software companies on focusing on the U.S. domestic market versus going international? And what did you experience over the very different stages of all those businesses?
Well, I think there's a couple of answers to your question. I was going to go two different ways. One is, I think, yes. I mean, in Fortinet, we were very fortunate. We had a very, very strong leader and sales team in Europe. And historically, we have, over the years, more of our revenue came from Europe or EMEA than it did from the US because we had a strong team there. I think the reality, though, is, be careful how much you invest there. How many countries you go in at one time. Having strong leaders is really, really important. Understand the business. So I think going international for a software company is absolutely required, really, really important. But make sure you hire good people and figure out how to invest in a way over time that that you're able to get a decent return on that investment back. So I'd be very, and we do it in a staged approach. But I'd say the most important thing is you have to have a great leader in running wherever, whether it's Europe or whether it's China, which is tougher now, obviously, Japan or Asia or whatever.
Yeah. Well, Ken, thank you so much. Any parting words? Things people should know about what you're up to, or advice?
Well, I would say, yeah, I'll give you a couple of parting words. One is, when I left Yahoo in 2017, I wasn't planning on doing anything. But this is where I said before, be really thoughtful on all the relationships you make. Eric Schmidt was on the board of Siebel. When I left Yahoo, he talked to one of the guys that helped me run his family offices, and he connected with me to ask me if I might be interested in running his family office. And I wasn't sure what I was going to do. And after one thing led to another, and I ended up running Eric's family office, if you will, Hillspire, for 5 years. It was a great run. I liked it because, my job was more of an operating role. So I had, we had well over 500 people in the organization at the time. And so I had basically a CEO. And so I had the ability to develop all the policies, procedures, the way I wanted to run something. So it was a much more expansive role than a CFO role. I don't believe CFOs make good CEOs generally in technology companies, but this was not a technology company. So I really enjoyed that. The relevance here is I became sort of a perceived guru in family offices. So I now get invited to a whole host of family office conferences, and there's a ton of these, and I speak at many of them. And so I sometimes in LA, sometimes a lot of them now are in Florida, Miami, Fort Lauderdale, Palm Beach, and so that's one of the things that I've done. So I've been around for a long time. My perspective is, I'll just say it this way: I'm in Silicon Valley. There's still a lot that goes on here, osmosis. I can meet people for breakfast, lunch, coffee, whatever. So much goes on here. If I lived in a place called, I'll throw it out, Naples, Florida, I'd be basically golfing every day, even though I'm a horrible golfer, playing pickleball with a lousy pickleball player, figuring out where to go to dinner. So by being in a place where there's so much going on, I'm engaged. I meet people all the time. That keeps me very, very engaged. And so I don't want to retire per se. I don't have a full-time job per se, to use that term again. But I'm totally active. And I think I think to stay mentally active, physically active in the game is really, really important if you can find a way to sort of balance and have some free time. So those are my things. I enjoy what I do. I just say this: I enjoy what I do. I'm an active investor. I'm in a ton of venture funds, as I said earlier. I'm doing more in private equity, a little bit more in private credit. I still do real estate as an investor. So I stay active. A lot of people know me and find me, and I speak at a lot of conferences. I get invited to a lot of conferences. I was just at RFK Human Rights, which is Kerry Kennedy's thing. I was just in CNBC Tech Council. They invited me. JP Morgan has a board of directors. They're nice enough to invite me. So I still get out and about. And I
Well, that
stay
sounds
relevant.
great. And you pointed out it's important to have diversity at the board level, and you bring a unique set of experiences. So I think they're all lucky to have you. Well, Ken, thank you so much, and hope to see you soon.
Yeah, I would just say this: never quit on yourself. Be consistent, be demanding, work hard. Just never quit on yourself, and just keep on going. And it's a great world. And one last thing I do want to say: I think when you talk about investments, I think the USA is still the place to be. It's a great, it's great, a great country. So I do most of my investing in US based funds, although I am now doing a little bit more in the Middle East. We can talk about that some other time, but I'm now starting to do a lot more in the Middle East because I think that's a lot of great demographics there. And I am seeing a great entrepreneurial spirit in the Middle East. So that would be the one thing I'd leave is for people to think about the Middle East in terms of their investing. It's a great area, and hopefully we'll get through some of these wars going on right now, and people will live in a very peaceful area. But I'm a big believer in Israel and the Middle East in terms of investing.
It's contagious, the kind of energy of
It's
positive.
unbelievable. And
Yeah.
so I'm seeing people when I go to family offices. I was at the Milken conference, and many people from the Middle East came up to see me. I've invested actually in a few of their funds over the last couple of years. The energy I see from people in the Middle East now to do a lot of, they love the U.S. approach, and they love work with the U.S. And so I would just say it's very entrepreneurial. I don't see that same entrepreneurial spirit in Europe, in my opinion. That's just
Yeah.
my personal opinion.
Yeah, no, it's true. I mean, I spent a lot of time in the UK, and everyone just feels like caught in some depression of this
I
Brexit
know.
didn't work out well. They're trying to get their bounce back.
Someone said Europe loves to export regulation.
Ugh. Yeah, well, it's a beautiful place, but you're right. The energy and the optimism. I mean, you find it in certain parts of Southeast Asia. I think Singapore and Jakarta and Kuala Lumpur, these places are on the rise as well. But Ken, without a doubt. Well, thank you so much for your time, Ken. I hope to see you again in the real world.
Thank you very much. Thank you very
Okay.
much. Thank you for having me. Bye-bye.
Bye.